quite a straightforward one. So please follow me closely. We will start with some MCQ questions. Then we'll go to the calculation part. The calculation part, a lot of repeating questions. So I will cover all of it. So please follow me closely. And now I hope that you have your question with you. All right, there's a lot of questions today actually. Okay, so let's start with the MCQ first. So MCQ, I won't write anything on the board. I will just do it verbally with all of you. I hope that you have the questions with you, and then we can proceed faster in that sense, and we can spend more time on the calculation. So question number 1 here, the changes in a firm's future cash flow that are direct consequences of accepting a project are called, what is this? So basically, when there's a change in a firm's future cash flow, okay, this is called an incremental cash flow, increase of cash flow, incremental cash flow. So number 2 here, the annual annuity stream of payment with the same present value as a project cost is called the project what cost? So the annual annuity stream of payment with the same present value as a project cost is called the project's equivalent annual cost, EAC, equivalent annual cost. Okay, so just fill in the blanks, very simple. So number 3 here, a cost that has already been paid or the liability to pay has already been incurred. It's a, okay, something that you already pay and something that you already, and we call it a liability. Okay, some people call it a bad debt. This is called a sunk cost. Okay, a sunk cost. That means very hard to recover already. Something that you already committed into. So number 4, the most valuable investment given up in an alternative investment is chosen is an what? So this is opportunity cost. Okay, and opportunity cost. So all these are basically very standard theory questions that you can read it via the textbook or from the lecture slides, that you need to understand it or that you need to know it. Whether you're going to memorize it or not, it's really depend on students. So some students can understand the concept, the logic behind it, then it's going to be easy. So number 10, interest rate or rates of return on investment that have been adjusted for the effect of inflation are called real rates. Okay, real rates. So number 11, the increase you realize in buying power as a result of owning a bond is referred to as the real rate of return. Okay, the real rate of return. So that means after taking into consideration of deducting the interest rates and inflation rates and discounted rate. So this is the real rate. Number 9, which of the following should be included in the analysis of a project? Okay, so in a project, usually you include only the 3 things: opportunity cost, erosion cost, and incremental cost. Sunk cost included because it's already committed. Okay, he's already committed one. So you know, see how is it gonna be extra when you're analyzing a project. Moving on here, question number 20. All of the following are anticipated effect of a proposed project. Which of these should be included in the initial project cash flow related to the net working capital, NWC? Okay, so all of the following are anticipated effect of a proposed project. Which of these should be included in the initial project cash flow related to net working capital? So the one that you need to put inside is number 1, an inventory decrease of 5,000. Number 2, an increase in account receivable of 1,500. And number 4, a decrease in account payable of 2,100. Okay. So this is talking about project cash flow lah, and how to count and how is it related to the net working capital. Okay, basically talking about money inflow and outflow. All right, money inflow and outflow. So inventory decreased by 5,000, and increase in account receivable and decrease in account payable. So increase in fixed asset is not affecting the cash flow. Okay, so fixed asset is basically on your balance sheet. So 21, changes in the net working capital. The answer to this is A, can affect the cash flow of a project every year of the project's life. Okay, net working capital or your net WC can affect the cash flow of a project every year of the project's life. 28. 28. The salvage value of an asset creates an after-tax cash inflow to the firm in an amount equal to the answer to this is C, sales price minus the tax due based on the sales price minus the book value. Okay, so this question we will see later in one of the calculation question there on calculating salvage value. All right, that time you can see clearer. So the answer here is C, sales price minus the tax due based on the sales price minus the book value. Okay, so deducting the tax from the sales price based on the SV minus BV. All right, so move on. Let's move on to the to count your, what do you call that, your calculation question. So I think your calculation question is started off with additional question from textbook, question 15. So this question 15 we'll do later lah, huh? So we will do the one that being scanned to you. Okay, we start with question number 1. All right, we start with question number 1. So stop me if you have any difficulty understanding. All right, then I will proceed to address it to you in a slower manner or in a more understandable manner. So let's see at the question number 1. Calculating project NPV. This is the first question. Raphael Restaurant is considering the purchase of a 9,000 Souffle Maker. Okay, $9,000 Souffle Maker. The Souffle Maker has an economic life of 5 years and will be fully depreciated by the straight line method. All right, so the price of this is 9,000 and then it will be depreciated to 0 in a straight line method for 5 years. So let's look at the depreciation first. So 9,000 divided by 5. Okay, so the depreciation is going to be 1,800 per year. This is depreciation. The machine will produce 1,500 souffle per year. Produce 1,500 souffle per year. With each costing 230 to make an price at 475. So each one is priced at $2.30. Okay, and then it's priced at $4.75. Assume that so just write down production is 1,500 per year. Cost $2.30 per unit, and selling price. Selling price is $4.75 per piece. So discount rate is 14%, tax rate is 34%. Should Raphael make the purchase? Evaluate, should you buy this machine or not? Interest rate is 14%. Your tax rate is 34%. So these are the information given to you on buying a souffle machine. Okay, you know the depreciation is 1,800 per year. So now what you need to do is you want to count the NPV. Okay, the net present value of this investment. But before you go to net present value, you need to find out the operating cash flow. Operating cash flow for 5 years. Okay, operating cash flow for 5 years. So to count OCF, what is the formula? So basically, you can just do income statement. All right, you can just use income statement. Okay, so income statement, how do you do? Or you want to use OCF. OCF, the formula is sales minus cost multiplied 1 minus tax plus tax multiplied by depreciation. Okay, this is basically how you want to use OCF. So if you use OCF, you basically just take your sales. Sales is how much? $4.75. 4.75. Okay. Multiply by 1,005. Your cost is 230. 230 multiplied by 1,005. All right. Then close bracket multiply by 1 minus t. Okay. Yeah, after tax, tax amount is 0.34. So 1 minus t means after tax, the value is 0.66 of this whole total. Plus the d, tax times depreciation. So this is the depreciation tax shield. Okay. How much you are having a tax shield on your depreciation of 1,008. You're going to get this back. So this will give you an operating cash flow of 3037.5 for year 1 to year 5. If you're going to put this into a timeline, if you're going to put this into a timeline, 0, 1, 2, 3, 4. These are the expenses in a monthly basis. Yearly basis. Initial investment, $9,000. Okay, so if to calculate NPV, negative $9,000 plus 3.37.5 EVIFE for the next 5 years, and interest rate is at 14%. You can get your NPV. Okay, you can get your NPV. For those who don't want to do this, you can use your financial calculator. Or worst case scenario, you're hardworking enough, you want to do the old school method, you can do this 3037.5 divided by 1.14 power of 1 ... continue all for 5 years until 3037.5 divided by 1.14 power of 5. Then you get NPV. Or if you want to be more convenient, you can use calculator. Cash flow at time 0, negative 9,000. Okay. Cash flow at time 1, all right, 3037.5. Frequency of time 1, repeat 5 times, so 5. Okay. Interest rate, you put there 14% straight away. Compute NPV. Straight away, you get your answer 1427.98. Okay. So the answer here is 1427.98. This is a positive NPV. So whenever NPV is more than 0, you accept. Easy, right? Okay. So far, any questions? Boys, girls, any questions so far? Yes, no? No questions. No issues. Okay. So I'm pretty sure it's quite straightforward, very in-depth, I'm telling you here already. So I think you guys are good. Okay. So please follow whatever I mentioned to you. Lots of methods. You want to use a financial calculator, you want to use a scientific calculator, you want to use this factorizations method, also can, up to you. Again, it all depends on you guys to choose which one you are most comfortable with. Okay. So moving on to question number 2 here. Let me have a drink, a bit dry. Okay, question number 2 here. The best manufacturing company is considering a new investment. The financial projection for the investment are tabulated here. So they already tabulated the financial projection over there. The corporate tax rate is 34%. Assume all sales revenue is received in cash, all operating costs and income taxes are paid in cash, and all cash flow occur at the end of the year. All net working capital is recovered at the end of the project. Okay, simple. So very easy. All right. They already provide you here, year 0 to year 4. Let's see how you're going to do this. I'm going to draw it out for you first. Okay. Let's see. Year. No, we don't use red pen. Year 0, 1, 2, 3, 4. Okay. So income statement. You use income statement to find your operating cash flow. So income statement is started with sales, okay, minus cost, minus depreciation. So year 1, your sales is given to you. All this is on the table. 12,500, 13,000, 13,500, 10,500. The cost 2007, 2008, 2009, 2100. Depreciation 6,000 for all years. I should have used Excel to do this to be easier. Okay. I'll draw a line. From here, from this value given to me, I can already count my EBT. This is your income statement. I hope you guys remember. So 12,500 minus 2.7 minus 6,000. Minus, all minus, okay? So here you get 3,800. 4,002, 4,006, and 2,004. These are earning before tax. After getting in earning before tax, you know you are being taxed 34%. So count your tax for each of anyone. 0.34 of 3,008, 1292. If you're using Excel to do this, it will be faster. You just drag across with the formula 1428, 1564, and 816. Then here you get net income. So fast already, get net income. Net income. After deduct all this, again after deducting the tax, you get your net income. So here we 2508, 2772, 3036, 1584. So to get your OCF is net income plus depreciation. So add back 6,000 to all of it. Total up together, this is your OCF, which is very important for you to calculate your NPV. Again, you must find your OCF first. Year 0, all right, add together 8508, 8772, 9036, 7584. Hope I did not show the wrong one. Okay, so not enough. All right, already done until here, OCF ready. You are still having certain things that you haven't done yet, which is the net working capital and taking into consideration of the net working capital spending that happens in every year. So let's see what to do here. So initial investment in year 0. Okay, the whole project costs you $24,000 year 0. So here is negative $24,000. Your NWC, even in a table, here negative 300, negative 350. Net working capital sure going to be negative one. Okay, negative 400 and negative 300. Last one not given to you. Why? Because the question tell you all net working capital is recovered at the end of the project. So 300 plus 350 is 650, 650 plus 400 is 1050 plus 300, 1350. So at the end there, you get back all your net working capital, you get a positive, plus 1350. Okay? Be very aware about this. NWC at the end of the period, you always get it back. You always get back from the previous years. So now, what is this last thing here? Is called the incremental cash flow due to the net working capital. So now you can calculate your NPV already. Yes, 24,300, 8158. Use all this number to count your NPV. And lastly, 8934. So these are your cash flow, okay, or your figures here to count your NPV. All right. Okay. So how to calculate this? Again, I show you a lot of method just now. So you can do NPV, all right, negative 24,300 plus 8158 divided by 1 point, what is the rate? 12. 12 power of 1. 8372. 1.12 power of 2. 8736. 1.12 power of 3. And 8934. 1.12 power of 4. Again, you need to count one by one, add up together. Calculator, just key in, same thing. CF0, negative 24,300. Cash flow 1, 8158. F01, 1 time. This F is frequency. If it's repetitive, you can put repetitive 2 times, then you put 2. 3 times means 3. If it's not repetitive, only put 1. Then move on to the next cash flow. Cash flow 2, 8372. Frequency 2, 1 time only. Then moving on. Cash flow 3, 8736. Frequency 3, 1 time. And lastly, cash flow 4, 8934. Frequency 1. Put in your interest 12. Okay. Compute NPV. So irregardless whichever method you use for this both, you'll get this figure, negative 1553.87. So the moment you see a negative NPV, you reject. Okay. So you see question number 2 there, they call you to compute the incremental net income for each year. Incremental net income for each year. This one is A. Then compute the incremental cash flow for each investment. This is B. And lastly, suppose the appropriate discount rate is 12. What is the NPV? C. This is A, B, C. The 3 different part of the question of number 2. Okay. I did not use Excel, so I'm just using here. I hope that you can see clearly. Of course, with Excel, you can just drag across and get the answer easily. So in the end, you get an NPV of negative 1553.87. Any issue so far? Are you okay? No issue. Very good. Okay, fantastic. No issues. All right. No issue, we move. No issue, we continue. So, question number 3 now. Down under Boomerang Incorporation, it's so like a positive ending. How? Sure not. Positive how much? It means the figure is the same. Okay, so we count together and see do we get the positive one or not. Shouldn't be, ma. 8158 divided by 1.12. Here should be 7283.93. 7283.93. 8372 divided by 1.12 divided by 1.12. 6674.11. 8736 divided by 1.12 divided by 1.12 divided by 1.12. 6218.11. 934 divided by 1.12. 1.12 to 1.12. 5677.72. Okay, let me count. 5677.72, 6218.11, 6674.11, 7283.93. One 553.87. Oops. Yeah, I get positive also. All right. So it seems like the error here. So it's a positive after my calculation. Okay, very good. Thank you for letting me know. So at least I can let the next class know. All right. So positive 144. Let me edit my answer sheet first. Positive 1553.87. Yes, you're right. Okay, so accept instead of reject then. All right, accept instead of reject. Okay, so answer is positive 1553.87. Very good. It shows that you guys really got do the calculation. Okay, so that means I'm given the wrong answer sheet here. Okay, so can we move on now? So we clarify here. So the answer is positive 1553.87 after we do the calculation together. Okay, this is what I get. All right, negative 24,300 and all this up together is exactly get 1553.87. Can? All can get? All can get, positive 1553.87. All right, very good. Thank you. Thank you for all of you for letting me know. So please keep up the good work and double check it together with me. Yeah? So we see whether do I do more mistakes or not. So let's see. Question 3 now. Question 3 here. Down Under Boomerang is considering a new 3-year expansion project that requires an initial fixed asset investment of 1.4 million. So your capital here is $1.4 million. Okay, the cost is 1.4 mil. The fixed asset will be depreciated straight line to zero over its 3 years tax life, after which is worthless. The project is estimated to generate $1.12 million in annual sales, which costs of $480,000. Okay, the tax rate is 35 and the required rate is 12%. What is the NPV? This is similar to question number 1. So cost is 1.4 million divided by 3. Depreciated for 3 years all the way to 0. So count 1.4 million divided by 3. Okay, 466,000, 666.67. Yeah, 466,666.67 per year. Depreciation. Okay, depreciation. So this question got no net working capital and so on and so forth. So you can straight away use the OCF method that we used on the first question. OCF is equals to sales minus cost multiplied by 1 minus T plus tax times depreciation. Okay, so they tell you it can generate sales of $1.12 million. Just fill in. just put 1,120,000, and it cost them $480,000. Tax is 1 minus 0.35, so it's 0.6533 plus tax 0.35 times depreciation of 466,666.67. Add this up together, you can get your OCF for the next 3 years. All right, you will get 579,333.33. This is for year 1 to year 3. Year 1 to year 3. Ignore this now. They give me auto circle. Okay, year 1 to year 3. So if you put in the timeline, year 1, 579,333, year 2 until year 3. And then initially in year 0 is a sunk cost of $1.4 million. So your NPV should be negative 1.4 mil plus 579,333.33. Okay, PVIFA because it's repeating. So for 12%, 3 years. You can get NPV. Calculator, no need me to repeat. Same thing. Cash flow at time 0. Negative 1.4 million. Cash flow 1, 579,333.33. Frequency of cash flow 1, repeat 3 times. Interest is 12%. Compute NPV. So what do you get? Let me know. Come on, this is easy. Thank you, Brawin. Fantastic. Negative 8539.09. So therefore, you reject. Okay, very good. Negative. So negative means, therefore, reject. You are not gonna invest in this 3 years expansion. This project will make you losing money. Okay, so you're not gonna invest. All right. So all can get, huh? Okay. So question 4 here is the continuous of question number 3. So in the previous problem, suppose the project require an initial investment in net working capital of $285,000. Okay, and fixed asset will have a market value of $225,000 at the end of the project. What is the project year 0 net cash flow, year 1, year 2, and year 3? And what is the new NPV? Okay, so very simple. So basically, in the first year, you need to add another $285,000 as net working capital. Okay, so let's see how to do this. So just now this one, you put into a timeline. We put year, black color, year 0, 1, 2, 3. Okay, so just now from our OCF, we already know here 579,333.33, 579,333.33, and 579,333.33. So this is remaining the same for 3 years depreciation straight line. The only new thing now is in year 0, you have the initial investment, 1.4 million money outflow, and your net working capital now of $285,000. Okay, so as usual, net working capital at the end of the year, you'll get back the end of the project, you get back this $5,000. So what are the new difference here is that the fixed asset will have a market value of 225. That means at the end of year 3, okay, the whole project could be sold off with a salvage value of $225,000. So got value. Although in your book value is 0, right? But then inside, you can still sell it for $225,000. So what is the calculation for here? This one is in the 3rd year. Okay, that you need to include here. We call it the after-tax salvage value. Okay, so what is the after-tax salvage value formula? It's very easy. Okay, it's very easy. So it's basically the market value 225,000 plus your 0 minus MV. 0 here is a book value. Book value is 0 minus your salvage value. Okay, so after salvage book value minus market value multiply by tax. Okay, multiply by tax. All right. So in this case, market value is $225,000 plus here is how much? Book value is 0. 0 minus market value is negative 225. Times tax. The tax given to you here is 35%. Okay, 225,000 times 0.35, 78,750. Okay, so 225 plus negative 78,750. 78,750. Positive, negative become negative. So 225 minus 78,750. So your after-tax salvage value is 146,250. So this is the amount that you will get when you sell off the project on the last year. So your after-tax salvage value 146,250 will be coming in the end of the year. All right. So now, with all this new addition, calculate your NPV. Okay, so first you're done with this ready, then this is your incremental cash flow. That means got changes ready, become incremental. So here will be 1.685. $579,333.33. 579,333.33. This one add all together. 579,333.33, 288, 285, 146 add together. Okay, you get here 1010 583.33. Okay, so with all this new info here, you can calculate your NPV, your new NPV here. Okay, your new NPV. So calculate here. So key in NPV. You can do the two methods. One is the financial calculator method. One is the standard calculation method. So financial calculator means easier for me to write. I'll write the financial calculator. The standard one, you know, negative 1.68 plus 579,333 divided by 1.12. Right, 1.12, right? Yeah, 1.12, power of 1, power of 2, and power of 3. So if you're using cash flow of financial calculator, negative 1685000, cash flow 1, 579,333.33, frequency 1 times 2, cash flow 2, 1010, 583.33. Frequency of cash flow 2 is only one time. Interest is 12%. compute NPV. What do you get? Initially is negative 8539. So now how much? Positive 13416, right? Okay, you get a positive 13416.14. So instead of reject, now you can accept. Okay, because got salvage value already. All right, the end of the year, you get back your salvage value. That's why now it's more a worthy investment because you still got return. Can all can get Anyone facing any difficulty so far? Anybody need any assistance? Please let me know. Okay. All right. So question not done yet. Question still not done yet. All right. Why not done yet? What is the next question is asking about here? All right. In the previous problem, suppose the fixed asset actually falls into the 3-year MACRS class. All the others, okay, facts are the same. What is the project's year 1 net cash flow now, year 2, year 3, and what is the new NPV? New headache coming already now. What is the headache? They want you to use the MACRS table. So what is this MACRS table? So I hope that is attached with you. I don't know whether you got it or not with you. All right. Let me find. Is there MACRS table or not? Oops, I think it's not attached here. Let me find on Moodle, see whether on your Times, see whether it's there or not. MACRS table. If any of you found it, you can let me know also. Nope, don't have. Hold on a moment now. How come it's not being given to you? Let me see. So blur. Okay, so All right, ignoring the rest of the things here. Let's look at here. So take a look. This is the MACRS for the 3 years depreciation. Look at the 3 years table. Okay, so look at this. Look at this section. Guys, look at here. Pay close attention because this is a free one. Free MACRS table, but it's always the same. So if it's for 3 years, look at this 3 years. So first year, okay, the value of $1.4 million will be depreciated 33.33%. Second year, depreciated 44.45. And third year, depreciated to 14.81. Until end of that, the salvage value is only worth 7.41%. That's what it means. Okay, so remember, take down this 33.33, 44.45, and 14.81. Okay, so now back to our calculation. Let me show you in the calculation. All right, just now this one, we already calculated the standard depreciation, a straight line all the way to 0. So if the question asks us to use an MACRS table, so we need to count the depreciation for year 1 to year 3, all different already, all different in value. So let's see, how does it affect our NPV? Okay, let's say if you're using the MACRS, all right, your year 1 depreciation, year 2, year 3 depreciation, all different already. So year 1 will be 1.4 million multiplied by, just now you see it's 33.33%. Okay, so it's basically 0.33, oops, 3333. Okay, this is the depreciation of year 1, 466,620. Okay, 466,620. Year 2, 1.4. And then is 0.4445. That means 44.45%. This will give you a depreciation value of 622,300. Third year, lesser depreciated, is at only 14.81%. So over here is 207,340. So your total depreciation now, it's a sum of 1,296,260. 1,296,260. Okay. So once you got this, you want to count the book value. Okay, the book value of your project at the end of year 3. Initial investment 1.4 million minus 1,296,260. What do you get? Let me count. $103,740. Okay, so if you remember the table I showed you just now, all right, after year 3, the salvage value is 7.21%. If you remember, just now you look back, it's 7.21%. Okay, so another way you can use straight away 7.21% times the initial value. I just show you the MACRS table, right? Just now, did I show you? I show it to you just now, right? MACRS table. Did you not see that? Can see or not? Sinling. I show you here. So that's the purpose, right? I show you here. So based on MACRS table, this is the depreciation of every year. Every year, this is the value depreciated until on the final year, it's actually worth only 7.41%. So go back to our calculation. 7.41%, not 21. 7.41% or 0.0741 of 1.4, you get 103,740. Okay, so this is the book value. So in your accounting record, this is the value here. All right. So remember, the whole thing affected your depreciation, okay? Affected your salvage value. So that's why we're counting the book value now. Okay? We count this book value is to count the after tax salvage value, which we do just now. So the formula again is salvage value, okay, plus book value minus salvage value multiplied by tax. So salvage value, same like previous question, is 225,000. But just now book value is 0. Now you got book value 103,750. Sorry, 740 minus 225 times your tax of 0.35. Okay, so you got higher tax shield. Higher tax shield already now. 103,740 minus 225,000 divided by 0.35. You got 42441. Negative 42441. So 225 minus 42441, you get your after tax salvage value of 182,559. So you receive more money now, okay, because of the tax shield. So you receive 182,559 instead. So now make your new incremental cash flow. Okay, make your new incremental cash flow. Because of the new changes, right? Again, year 0, 1, 2, 3. Already changed differently. So now your new OCF. Okay, or you want to count everything over again from net income. All right, take back your net income just now to calculate. If not, you can use back the net income the long way. Or if you want the easy way out, since we already go through all these things, you want to do the easy way out, you do OCF one by one. OCF, sales, minus your cost. All right, multiply by 1 minus tax. 1 minus tax plus your tax depreciation. You can use this to do one by one on the cash flow on year 1, 2, 3. Okay, year 1, 2, 3. So basically, year 1 OCF, the sales is 1, you repeat everything over again. 1,120,000 minus your cost of 480,000 times with 1 minus 0.35 plus 0.35 multiplied by your new depreciation. Okay, the new depreciation. So just now you calculated the first one is 466,620. Find out what is your OCF. Year 1 OCF is how much? Do for year 2, same thing here, plus 0.35. Okay, 622,300. Year 3, repeat the same thing on top. This side is same, plus 0.35. The only difference is the depreciation. And the only depreciation section is different here now. That will affect your cash flow. So your new operating cash flow for year 1, 2, 3 will be 579. Okay, 317. 633. 805, 956, 128. So this is your new operating cash flow. Okay, new operating cash flow. All right. So once you got all these, do your NPV again. Okay, do your NPV again. So this is already considered your new what do you call that, incremental cash flow already. 579,317, 633,805, and 956,128. So in your timeline, it will be like this already. 0, 1, 2, 3. Here, initial investment plus your net working capital, which is 1685. Zero, zero, zero. Here, 579317. Okay. Here, 633805. All right. And this last one is not 956128. Okay. Here is only supposed to be 488569. So 488569 plus back your net working capital of $285,000. Sum of plus your salvage value that you count just now, 182559. This total will give you 956128. Okay, 956128. All right. This is your incremental cash flow. Okay, this is only OCF. Just now this is only OCF. 5793117, 6333805, and 488569. All these are the your OCF. After having your OCF, you need to include your net working capital that you receive back and also your salvage value, your after-tax salvage value. So all this total will give you 956128. Now you can count your NPV again. Use your calculator to count your NPV. Let me know what is your NPV. Okay, for those who are confused, I think maybe some of you are still confused. All right, basically, if you put into the table year 1, 2, 3, okay, OCF is 579317, 633 805, 488 569. Net working capital, year 0, negative 285,000. Come back in as positive 285,000. Initial investment 1.4 million. After tax salvage value 182,559. So this will give you incremental cash flow of negative 1685, 579317, 633805, and 956128. Then you can calculate your NPV. This is called your incremental cash flow. Okay, so when you transfer to the table, it looks something like this. It's the same thing. Cannot. What you'll get for your NPV? Come on, anyone? Anybody? Come on. Positive or negative? Hello? Can you hear? Cannot hear? Are you okay or not? Some response, please. Hello? How come no sound already?
Yes, sir, calculating.
Ah, no response at all. I thought, oh, fainted or what just now? Okay, come try. Tell me what you get. The NPV here. Calculator CF01. Correct. CF0, C01, F011, C02, F021, C03, F031. Interest 12%, same thing. Compute NPV. $18,065.81. Okay, very good. 18,065.81. 18,065.81. Positive NPV also, so therefore accept. How come so long to calculate this one? Okay, thank you, Trisha. 18,065.81. Very good. All right, I hope the rest got the same answer. Okay, take a bit long from the rest. I don't know why. So let's move on. Again, let's just move on. We still got quite a number of questions to go through. All right, I'll go a bit faster since you all can follow until here so far. All right, just that this question, they're giving you three different things. One, they initially call you to count without taking into consideration of networking capital and initial investments. Sorry, the networking capital and after tax salvage value. Okay, then after that, they modify it. They want you to use the MACRS depreciation table instead. So if in the exam, they provide you with this table, that means there's a question regarding this. So certain percentage depending on depreciation. So if 5-year depreciation, look at the 5 years depreciation section. How many percentage each year are being depreciated? Then you need to deduct it in your income statement to find out the exact answer. Okay, to get your OCF, and then if there's any amendment, you get your incremental cash flow. All right, so let's move to question number 6 here. So question number 6 here, your firm is contemplating the purchase of a new 670,000 computer-based order entry system. The system will be depreciated straight line to zero over its 5 years life. So let's look at this. A firm contemplating to purchase, okay? So it costs you $670,000. The system will be depreciated straight line to zero over 5 years. So depreciation divided by 5, this will give you 134 per year as depreciation. Okay, 134. It will be worth 50,000 at the end of the time. Salvage value 50,000. You will save 240,000 before taxes per year in order processing costs, and you will be able to reduce working capital by 85,000. This is a one-time reduction. If the tax rate is 35%, what is the IRR? They want you to find IRR instead for this question. Okay? So, again, straight line to zero to find your after-tax salvage value. Salvage value, okay, plus book value minus salvage value times tax. So if salvage value is already 50K, book value is 0, so here is negative 50K multiplied by your tax is 0.35. So this will give you a 32,500. So in final year, you can sell at 32,500. Okay, so count your OCF for year 1 to year 5 for the 5 years. All right, year 1 to year 5. So again, use OCF again. OCF, sales minus cost times 1 minus T plus T times depreciation. Same old calculations. So the sales here, they are telling you $240,000. All right, you will save $240,000 before taxes per year. So they never tell you the costing. So it's basically $240,000. 1 minus T plus T times depreciation of how much just now I calculate? 134. So every year is the same. Every year is going to be the same. So your OCF is 202,900 year 1 to year 5. It's all the same. Okay. So put into the table. Year 0, year 1 to 4, and year 5. So that means all these 4 years in between here are having the same 202,900. Year 5, because you take into consideration of working capital. So they tell you this project, okay, you invest in this project, you will be able to reduce working capital by $85,000. Okay, so this one is a bit opposite. Net working capital at year 0, you gain $85,000 in advance. All right, because they're telling you you'll be able to reduce working capital, you reduce. So assuming now is positive, at the end of the day, it's gonna be negative. That means it will be included also lah. It's always like that. NWC at year 1 is if it's negative, then you get back at year 5. If it's at positive, then year 5, assuming that you'll be used out or being paid out instead. Okay, so this is our net working capital. So initial investment, which is a costing here. Just now we see like the question is $607,000. This one is negative. And lastly, your after tax service value that we calculated just now, 32,500 coming in the final year. At year 0, you get negative $585,000. 202,900 remain the same. This one 150,400. This is your incremental cash flow. So this thing, they never give you your IRR. Okay, so if you use a financial calculator, this one must use financial calculator. If you use the scientific calculator, you're going to be try and error. It's going to take very long time. So if you use financial calculator, CF0 is negative 585,000. Just key in. C01, 202,900. F01 times 4. Repeat 4 times. C02, 150,400. F02, 1. Straight away click compute IRR. Okay, so we click compute IRR. Yes, you will get 20.06%. Yes, very good. 20.06%. This is the IRR of this project. So we don't know whether we should accept this project or not because they never give you a required rate of return. So they just call you to compute IRR. So the IRR of this project is 20.06%. Okay, in other words, they're telling you the return is 20.06%. But usually IRR, you need to compare with the required rate of return. So this question they never give you. So you cannot say accept or reject. There's no benchmark to it. Okay. So moving on. Okay, I'm not stopping as well. We're going to continue. Still a lot of questions to go. So let's go to question 7. Okay, question 7. DocCup is looking at a new sausage system with an install cost of $375,000. This will be depreciated straight line to zero over the project's 5-year life, at the end of which the sausage system can be scrapped for $40,000. The sausage system will save the firm $105,000 per year in pre-tax operating costs, and the system requires an initial investment in net working capital of $28,000. If the tax rate is 34% and the discount rate is 10%, what is the NPV? So as usual, okay, until now, I think you already know what to do. Okay, the first step of, you must know the cost. Okay, it costs you $375,000 divided 5 years straight line. Okay, you want to count the depreciation. Okay, once you got this, you want to count the ATSV. The after-tax salvage value here, the tally can be scrapped off at $40,000. Okay, $40,000. Again, $40,000 plus negative $40,000 multiplied by the tax rate of 34%. So your after-tax salvage value is 26,400 final year. Next, count your cash flow from year 1 to 5. Use your OCF. So what is the sales here? The sales here is $105,000. Will save the firm. So that means this is the income that you generate. So it doesn't mean must be sales. It's basically income generate $105,000. Any outcome, any outflow of money, don't have, no costing. So close bracket 1 minus T. Plus T multiplied by depreciation. Okay. So your OCF is 94,800. Year 1 to year 5. So with all this given information, you can start doing your incremental cash flow again. All right, incremental cash flow again. So very simple, year 0, year 1 to 4, and year 5. All 94,800. Again, this is OCF. Net working capital, initial investment. Net working capital given to you 28,000. Year 5 come back in. Initial investment, it's 375,000. And of course, ATSV 26,400. Add this one together, you get your incremental cash flow again. $403,000, 94,800, 149, 200. Key into your calculator, compute NPV. Okay, key into calculator. F01 4 times, C02, F02 1 time. Interest is 10%. Compute NPV. What do you get? Positive or negative? Come, help me to count. Positive or negative? Negative 9855.2. Okay, negative 9855.29. Very good. So this one you need to reject. Okay, therefore reject. All right. So, any rocket science so far? Anyone are confused until here? Those quiet students, for the past few 1 hour plus, you did not talk one. Are you okay? Are you all right? Very good. Okay, seems like all good. So please let me know if you cannot follow. All right. The NPV question has been all repetitive. It's actually very similar to each another. Okay. So again, come to the following question, question 8 here. They will ask you about MSCRS again. So once again, we can try it out, the MSCRS given table. So over here, they tell you an asset used in a 4-year project, 4 in the 5-year MSCRS class for tax purposes. The asset has an acquisition cost of 7.1 million and will be sold for 1.4 million at the end of the project. If the tax rate is 35%, what is the after-tax salvage value of the asset? So, clear this off. Okay. Now, I show you the table again. You see, MSRS for 5 years. This is the table. So this question is telling you the asset will be used in a 4-year project, falls in the 5-year MSCRS. So they're telling you to look at this chart, but then it's until 4 year. 20%, 32%, 19.2, and 11.52. So this is the OCA for the first 4 years. Okay? OCA for the first 4 years, and then you will sell it off. All right? You're selling off this project at 1.4 million. So let's start counting. So remember this, 20%, 32%, 19.2, and 11.52. Okay, so this is from the table. This is the depreciation amount according to year, from year 1 to year 4. Okay, so start by counting the depreciation. Year 1 depreciation, the cost is $7.1 million. $7.1 million. So just now we see already the MSCRS value is 20%. Year 2, 0.32%, 32%. Year 3, 19.2, 0.192. Year 4. Year 4 is 11.52, 0.1152. So your depreciation for year 1 is 1420000. Year 2 is the highest, 2272000. Year 3 is 1363000. Year 4, 817,920. So this is your total depreciation. Add up all of this, you get 5,873,120. This is on year 4. Okay, year 4. So we're going to count the book value at year 4. Take 7.1 million minus 5.873 million. Oh, yes. My mistake. Sorry. So 5,873,128. This isn't correct, total. You get 5,873,120. Correct, No wrong, right? 2, 9, 9, 11, 10, 12, 13. Okay, correct. I think I'm right. Only that one. Only here got minor error. Okay, so book value after deducting, it's worth 1,226,880. Okay, 1226880. So this is the book value. But the after the salvage value is $1.4 million. So you make some profit there. Okay, $1.4 million. So 1.4 SV minus BV. Sorry, this is plus. Then plus BV minus SV times your tax. 0.35. So your after tax salvage value that you get in the end is 1339408. 1339408. Okay. This is the only thing they want you to find. They want you to find this only. 1339408. No need to find NPV, no need to find IRR. Very simple. All right. So you just stop here. You need to just use the depreciation to count your book value. Okay, to count your book value. And then calculate your after tax salvage value, which is 1339408. That's all. This question is there, just like that, just halfway through. Never ask you to find NPV or IRR. Okay. So now let's go on to question number 9. Souffle Petroleum is considering a new project that complements its existing business. The machine cost you $3.8 million. So this costing $3.8 million basically for you to count your depreciation only. Okay, the marketing department predict that the sales rate of the project will be $2.5 million per year for the next 4 years, after which the market will cease to exist. The machine will be depreciated down to zero over its 4-year economic life. So you see 4 years. So $950,000 per year depreciation. So each year they generate 2.5 million sales. Okay, the cost of goods sold and operating expenses related to the project are predicted to be 25% of sales. However, also needs to add net working capital of 150,000 immediately. Additional net working capital will be covered in full at the end of the project. The corporate tax rate is 35%. Required rate of return is 16%. Should Howell proceed with the project? This is basically asking you NPV. So depreciation given. Okay, telling you the sales amount also. So do your income statement now. Okay, income statement. Sales. Sales they generate how much? 2.5 million. How much is the costing? Cost of goods sold is 25%. 25% of your sales. So this is how much? 25 times 2.5 million. 625,000. Okay. Then depreciation minus depreciation. $950,000. $2.5 minus 950 minus 625. How much you get? Earning before tax $925,000. Then minus your tax at how much? 35%. 35 of 925 is 323,750. Deduct that, you get your net income. Okay, net income 601,250. Okay, net income 601,250. So you want to count your cash flow for the next 4 years. All right, you're gonna get your OCF is net income plus depreciation back 950,000. You get your OCF. OCF of 1551250. This is your OCF. Okay. So do into the table. Put into the table. year 0, 1, 2, 3, and finally year 4. Okay, OCF 1551 250, 1551 250. Initial investment 3.8 million. Sorry. Net working capital $150,000. Received back at the end of year. Lastly, after tax salvage value. So what's the after tax salvage value? Any salvage value or not? Oh, the net working. No after tax salvage value. Don't have. So no after tax salvage value means zero lah. Then you already got your incremental cash flow. Here is 3950, 1551 250. This one, this is not negative, one is positive, plus 15,000. This is $1,701,250. Calculate your NPV with this. Okay, calculate NPV. CF0, C01, F01, repeat 3 times. C02, F02, repeat 1 time. Interest rate is 16%. Compute NPV. This is question number 9. Okay. So I think you all should get a positive figure here. Should be a positive 473. $521.38. So someone please check whether that you get the same answer as me or not. Okay, please double check. Please double check the answer. See whether can you get the same one as mine. Come on, we need to move a bit fast. We got 3 more questions to go. Okay, very good. Thank you. Thank you, Shao Chen. Okay, we got the correct one. All right, let's go. Okay, let's move on. Question number 10 now. Calculating EAC. Okay, calculating EAC. So this is different again. EAC here means equivalent annual cost. Okay, equivalent annual cost, or also could be known as effective annual cost, EAC. So you are evaluating 2 different silicon wafer milling machines. The Tacron one costs $215,000, has a 3 years life, and has a pre-tax operating cost of $35,000 per year. Tacron 2 costs $270,000, has a 5-year life, and has a pre-tax operating cost of $44,000 per year. For both milling machines, use straight line depreciation to 0 over the project's life and assume a salvage value of $20,000. If your tax rate is 35% and your discount rate is 12%, compute the EAC for both machines. Which do you prefer? So to do EAC, very simple. Okay. First of all, compute NPV first. Okay, compute NPV, then you can compute your EAC. All right. So let's do the NPV for Tacron 1 first. You got two products here, so you go for NPV Tacron 1 first. Okay, Tacron 1, it costs you $215,000 over 3 years. Okay, so this will give you your depreciation 71,667 per year. Depreciation. Okay. Next, you want to count the operating cash flow, OCF. All right, no sales here. Okay, no sales here, but got cost of $35,000. So 0 minus cost, sales 0 minus cost times 1 minus tax, 35%. Plus 0.5 depreciation 71,667. Your operating cash flow here for the 3 years is 233.45. Okay, 2333.45. All right. So what is the after-tax salvage value? The after-tax salvage value for both products also the same. Okay, for both products also the same. So in this case, it's SV plus BV 0 minus SV multiplied by tax. So this one will give you 13,000. Okay, so now you got everything ready. All right, no net working capital for these two, very good. So you can say we count the NPV. All right, we count the NPV. NPV. So you need to do first the operating cash flow again. Year 0, 1 to 2, year 3. So all the cash flow is 2333.45. Okay, here's OFC. All right. Investment, capital. Oops, why is it lagging? Can you hear me? Oops, something's wrong. Very good. My whiteboard betray me. Hold on, hopefully we can continue. It is not a very good time to have such issue. Okay, all right. It came back alive. Good. Let me share it back to you. So OFC there, the cost is $215,000. Okay, and your ATSV, your salvage value is 13,000. Sum it up, you get your incremental cash flow. Here is negative 215, 2333.45, 15333.45. Okay, find your NPV first. Find your NPV first. Very quickly, find your NPV. So, compute NPV. All right. So by right now, this one you still get a negative NPV. Okay, you're gonna get a negative NPV. So negative 200, 142.3. So don't worry about negative NPV when you're calculating EAC because you're trying to calculate the costing. Okay, you're trying to count the costing, so it's fine. it's fine to have a negative NPV. All right. So this is NPV. So EAC formula, EAC is basically NPV divided by PVIFA. Divided by PVIFA. Okay. So if you want to use calculator, you assume NPV as your PV. Okay. Assume NPV is your PV. So you click in PV equals to 200,000, 142.3. Okay. Ignore the negative. Then your period N is 3. All right. Your interest rate here is 12% given to you, and you compute payment. This payment is to estimate your EAC. Again, is to estimate your EAC. For those who want to use the financial calculator, here will be negative 200, 142.3 divided by PVIFA of period 3 and 12%. If you have used PVIFA table, you can use that. If you're using calculator, PVIFA is basically this. 1 minus 1 plus R power of T over R. You just replace the 3 period to T and the 12% to R as 0.12. You get the amount. Divided this, you get a negative EAC. Okay? Negative 83329. Here also will get the same thing. Okay? So, here they are telling you equivalent annual cost. To use Tacron 1, each year you spend almost 83,329. So once you're done with Tacron 1, you do Tacron 2 now. Okay, you do Tacron 2. So this is Tacron 1, so we do Tacron 2 now. No space. Okay, next we count Tacron 2. Tacron 2 costs $270,000, but then it's depreciated for 5 years. So each year is $54,000 per year. This is depreciation again. Okay, this is depreciation again. So next, find the OCF. Don't wait ready. All right, no sales, so 0 minus the costing. The costing for Tacron 2 is $44,000 per year. It's in the question now, if you are wondering. Okay, 1 minus tax of 0.35 plus tax. Depreciation is $54,000. Okay, so year 1 to year 4 is year 1 to year 5. This is for 5 years. Your operating cash flow is negative $9,700. So it's a negative OCF. So put into the table year 0, 1 to 4, and 5. OCF negative means I put a bracket here, 9700, 9700. Your cost, $270,000. Okay, ATSV is the same thing. Final year getting back 13,000. Okay, both sharing same ATSV. Yeah. So your incremental cash flow here, $270,000, $9,700, and this one positive 3,300. Count your NPV. Okay, count your NPV. So Tacron 2 will give you a way bigger NPV. Negative 297,589.78. Okay, so with this, again, those who use calculator, this is your PV. Include your N equals to 5. Interest is equals to 12. Compute PMT. For those who never use calculator, EAC is equals to negative 297,589.78 divided by PVIFA, 5 years period, and at 12%. You will get the same answer. You will get negative 82,554. Okay? Tacron 2 costs you 82,554. Tacron 1 costs you $83,329 per year. So, Tacron 2 costs cheaper. Therefore, you will choose Tacron 2. Okay? You will choose Tacron 2. Alright. So, we need to move on. I got no time. Okay? I'm shortage of time. So the additional question from textbook, the question 15, I won't do. You need to refer to the, basically refer back to the solution when she uploaded it to you. Or worst case scenario, we'll cover it next week. All right, let's continue with question 11. Okay, question 11 first. So cost cutting proposal. Macy Machine Shop is considering a 4-year project to improve its production efficiency. So buying a new machine press for $640,000 is estimated to result $270,000 in annual pre-tax costing. Okay, the press 4 in MSCRS 5 years class, and you will have a salvage value at the end of the project of $70,000. The press also require an initial investment in spare parts inventory of $20,000, along with an additional $3,500 in inventory for each succeeding year of the project. If the shop tax rate is 35% and the discount rate is 14%, should Macy buy and install the machine press? All right. So again, this one must use the MSCRS table. I won't show you again. We already did it just now. So we just use back the percentage. So you count the first 4 years depreciation because it's a 4-year project. So year 1 depreciation. Okay. Initial investment here is $640,000. Okay, based on MSCRS table, it's 20% on the first year. Second year, it's 32%. Third year, it's 19.2%. And fourth year is at 11.5%. Okay, so this is from the table. All right, these figures are from the table. So you get 128,000, 204,800, 122,880, 73728. Okay, 73728. So next, you need to count the book value at the final year. So total first. What's the total amount here? Okay, find out the total amount, add it together, get the total amount. So your book value is equals to 640,000 minus this total here. 128, 204, 122, 73728. So your book value that you get, it should be 110,529. Okay, getting this book value, moving on, after tax salvage value, ATSV. Okay, salvage value, the question tell you, you can sell at the end of the day at $70,000. Okay, plus book value minus salvage value multiplied by your tax rate. So your ATSV, it's 84,207.2. Next is calculating your operating cash flow. Okay, calculate your operating cash flow. So your OCF will be equals to, so basically there is no there is estimated buying a new machine is estimated to result to pre-tax cost saving. So you're getting a cost saving, you're getting money inflow. So no money outflow. So basically is 270,000 multiplied by 1 minus T plus annual depreciation. So see what is your thing that you get. So this is cash flow year 1. Okay. Year 2, same repeating thing, plus 0.35, 204, 800. Year 3, same, only the depreciation is different. 122, 880. Year 4, 73, 728. So your operating cash flow here, you get 220, 300, 247, 180, 218, 508, and 201304.8. Okay. All right. Up until here. So let's read the question. The spare part inventory of 20,000 along with the additional 3 of each succeeding years and blah, blah, blah. So until here, you need to count the extra information. Okay. The project requires you 20,000 of net working capital at the beginning. Okay. And each successful year will be 3,005. So year 0, 1, 2, 3, and 4 years. Again, year 0, 1, 2, 3, 4. All right. So your operating cash flow just now, you already know. There's all these things. So you put in here 220, 300, 247, 180, 218, 508, 201, 304.8. Okay. This is your OCF. Net working capital, year 0 initial investment is $20,000. Then every year you need to pay 3,500. Okay. $3,500. I'm still conducting the class, right? So why are you so excited about attendance? And on the final year of the forge, you add up all this together. You receive one lump sum in positive. So 27,000, so it's 30,500. 30,500 here. Okay, 30,500. So your ATSV, and of course here is your costing, your cost of investment just now is $640,000. Your ATSV that you receive at the end of the time here will be 84,207.5. Yes, I know, but still got 3 more minutes. But how long you need to take attendance? Okay, so excited. I'll give you attendance first. Attendance. Okay, come on, faster. 2 more. E932J3. Come, 1 more. Okay, come back here. So let me finish this question, then I'll let you go. All right, we'll continue with question 12 and 15 next week. Okay, so back to here. All right, sum up together. So find your ICF again. So here will be total of 660,000. This one will be deduct this 220,000 divided minus 350. Find the answer. Okay, so it's just going to go through very fast. You find your answer. In the end, this project, your NPV, we should be getting 49,908.03. Okay, so I'll stop you guys here. I'll continue with you guys next week on the last question here and the extra question 15. All right, so we'll talk about this next week. So if I forgot to cover back next week, please remind me. All right, I'll see you guys next week then. Take care. So sorry for the delay and so sorry for the slow. I hope that you guys got it today. I'll see you guys next week then. Take care. Bye-bye.